What I'm teaching you is the internal dialogue of what we are doing. We are looking at the price. We are not thinking like the collective that is commonly referred to as the retail trader. Because majority of retail traders lose. They have a failed logic. They don't have consistency, they don't have longevity. So we want to try to think and engage differently with price. Hi guys, welcome back. This is gonna be a video summary of episode 6 of the ICT Mentorship 2022. Please refer to ICT original content. This is just a quick refresh if you have already watched episode 6 of the ICT Mentorship and you want a quick refresh reminder before going through with the next episode. In this episode, ICT tells us a little bit more about what we as his students should be focusing on, fair value gaps, and breaks in market structure. How do we internalize price delivery? How do we internalize the story of the price? What is going on in the markets? How do we think about it all? As ICT traders, we know that there is a market efficiency paradigm. On one hand, we have smart money, and smart money, which are also the liquidity providers, are really looking into cannibalizing retail traders, or better, uninformed traders. Smart money doesn't look at indicators, technical analysis, and all these fancy or less fancy things that retail traders use. Smart money looks at only one thing, and that's liquidity. On the other hand, we have those that are willingly or unwillingly providing liquidity, and those usually are speculative, uninformed traders. Knowing the market efficiency paradigm, we as ICT students think and behave a little bit smart. So we as ICT students try to think and behave in a smart way as well a little bit. So first and foremost, we do not trade patterns for pattern's sake. We do not trade indicator readings or momentum. We look to enter longs where retail traders are selling, and we look to enter shorts when retail traders are buying. We really try to anticipate price-seeking liquidity. And to do so, the time of the day is very important for us. And now I'm going to tell you a little bit more about the ICT fair value gap. And I'm going to divide the story between bullish and bearish fair value gaps. And as we see one specific, we're also going to touch upon shifts in market structure. So guys, let's talk about fair value gaps, and let's take first and foremost a little bit more of a general approach towards them. A fair value gap is, very generally speaking, an area of price inefficiency. In every fair value gap, there is a price level that's not being completely fulfilled, completely delivered. There is something that's missing. In a fair value gap, the price is being offered only on one side, either the buy side or the sell side. In every fair value gap, the price is not being efficiently offered to those that wants to buy it. So we know that eventually the price will want to come back to that level of inefficiency. Okay, let's start with an example, and let's start with the bearish fair value gap. The bearish ICT fair value gap is time-based, so it occurs in a very specific moment of the day. The liquidity pool has just been touched or violated by the price, which also means that the fair value gap is forming after a run into buy-side liquidity. If the above points are present, the fair value gap will have a 3 candles pattern forming in a very specific way. When you see this bearish fair value gap forming, you already know in that exact moment that you will want to sell short. And you are just gonna be waiting for the price to tap back into the fair value gap. And now let's talk about the ICT market structure shift, specifically the bearish one. So look on the graph above me, and please always start by looking at it from a chronological order, so from your left to your right. And the first things that you're going to see is that the price has formed some highs, such as point A. So that would be our buy side liquidity. As we are a little bit obsessed with time, also remember that this happens at a very specific time of the day. The price at that specific time will go above the old highs, so above point A, and it will form new highs, such as point B. By doing so, the price is going above the buy side liquidity, tapping into it and creating that new high, point B. And then right away, the price will quickly fall down, creating displacement. With that energetic move going down, with that displacement lower of the price will go below the old lows that has formed before. That will make the move even more significant for us. Between point B and point C, so between the displacement high and the displacement low, we are expecting to see a fair value gap to be formed. If that doesn't happen in that specific range of the price, we will not be trading, we will not be looking to enter the trade. Okay, that's very important. And now let's switch to the ICT Bullish fair value gap. Again, remember, it is time-based, so it occurs at a specific time. Right before the fair value gap is formed, the price has touched or violated a liquidity pool, and so we will find the fair value gap after a run into the sell side liquidity. If all of these 3 points are valid and have happened, then we are going to see a fair value gap forming, and so 3 candles forming in a very specific order. When you see that fair value gap forming right there at that time, you're looking to be buying long. So let's talk about the bullish market structure shift. We will observe that the price has formed some lows, such as the one in point A, below which we are going to find sell-side liquidity. At the right time of the day, when we would kind of expecting it, the price will go below these old lows and it will form a new low, which we see here with point B. Right after forming that new low, the price with a very energetic move will go up and it will actually close above the old high that has formed before. That displacement, that very energetic and loud move will sign for us the displacement. So from point B to point C, we have our displacement low and our displacement high. And exactly in that range, we are going to be expecting for the fair value gap to form. If the fair value gap does not get formed in that range, we know that we will not want to be trading. Guys, if you decide to be trading futures and if that's your market of choice, remember you're always doing it at your own risk, but also note that on TradingView, if you're using that platform, the data is a little bit delayed for the futures. And so you need to buy a data package to have it real time. If you decide to do so, remember that in the link in the description below, you find the PDFs, and on them you find directly the link to access TradingView, the tutorial, and how to do that. In episode 6, ICT gives us a very good example of the moves just explained with the fair value gaps and the shifts in market structure. He does it with the E-mini Nasdaq futures, and I'm gonna put a screenshot here so that you can look at it. Guys, try to see if you can spot fair value gaps, shifts in market structure before going back to the ICT episode and checking actually where he sees them. Guys, keep going, keep studying, keep doing the hard things. This is the way.